Hey everyone, welcome back. Today we're talking about sentiment. Now there's 3 chapters, I think it's 33, 34 and 35. We're going to bundle them all together. We may split it as we go, but I think these are pretty short chapters. So we're going to get through them fairly quickly. Obviously this again is new material for 2019. I think you know all the new material for 2019 based on the bid. So this is going to be stuff where again, it replaces existing material. We had material like this in the curriculum before, so there's going to be questions on this that may be framed a little bit differently. Again, you know, we'll go through the practice exams, bring out ones which we feel are no longer relevant to this curriculum, but could be asked, because as we've said before, all these questions are in a test bank, and it is really difficult for the CMTA to pull everything out. Hopefully they've done that and you're not going to have any issues. I would rather you just be prepared. So we're going to do that in our test banks as well to make sure that you've got access to that. All right, let's jump in the slides here. The first one obviously is the chapter 33, market sentiment technical analysis. This is probably one of the shortest chapters in the whole text, which is nice. We're going to define sentiment as it relates to markets. We're going to identify the general categories of informed and uninformed participants, discuss the importance of the crowd, and describe the challenges of using sentiment indicators. So we'll jump in there. What is sentiment? Basically, you know, the premise here is if we really did believe that everybody was rational, you know, in efficient markets, which obviously has that all participants are rational as one of the core foundations. But if that was really the case, then the value of a stock would be based on the company's discounted cash flow, their income, the proceeds of their sales, etc., and the expected dividends or the expected returns that an investor would get. And so that would be very rational and we wouldn't be getting these swings up and down all the time. But we all know it's not like that. We know that sentiment plays a big part. So if you think about it from a formula point of view, we have a valuation of a stock based on all the rational elements: cash flow, assets under management, assets and minus liability. So the total equity of the company, that type of thing. So we have this rational figure, but then around that rational figure, almost like a cycle, we have sentiment going up and down and up and down. And so that obviously has a big effect on it as well. Very difficult to break those two apart. I think if we could find a way of doing that, that would be a phenomenal indicator. Yeah, it's not so easy there. Sentiment explains if a stock is above or below its estimated fair value. Sentiment is bullish when price is above. If the price is up, then obviously people believe that this is a really good value and we should be buying more and more of it, and it keeps going up. So when it comes to the crowd, there's 3 major groups there that we need to look at. So the first one is index funds. Now these are probably the largest groups. So think of your ETFs. You know, you buy an ETF, it is going to distribute the monies that it receives into buying the underlying equities. Now that fund, or even you as an investor in that fund, really don't care about the sentiment and what's going on in that company. I should say the buying and selling decisions are being made purely based on that company's membership in an index. So as soon as a company enters the S&P 500, well then the ETF is going to buy it. The SPY ETF buys it, or the technology spider will add that into that fund. Whether sentiment's bullish, bearish, has no effect at all. What the crowd believes has no effect at all. It purely is based on index membership. So index funds are a huge one, and there are, you know, and I don't know the breakdown, but I suspect that there's a lot of money purely in index funds where people are just tracking the returns of the index. Institutional managers is another group there. They control large amounts of money. You know, they're working as portfolio managers, that type of thing. They also affect the sentiment of smaller investors. So these guys are the ones that are brought out on CNN, FN, and Bloomberg, and all the stations and radios, and their opinions matter. People want to know, what does Wall Street think about this? And so if someone comes out and says, you know, they're the managing director of equity research, and they say, we believe that this stock is overpriced, well, that has an influence on the individual investors and the sentiment of individual investors as well. So again, it's another group that we need to be aware of. The individual investors, obviously, are the third group here. They have strong opinions about the company. You know, they're investing their life savings, not just client money, but their own money in there. And so they have very strong opinions about whether this is going to go up or down, and you know, their analysis that leads them to that decision. They don't have access to the same sources of information. You know, the institutional managers, portfolio managers, they can go and sit with a CEO of a company. You know, so one of the largest portfolio managers could very easily go and set up a meeting with the CEO and just get a feeling for what's going on in that company. But as a private investor, you've got no access to that type of information. So as I said, they're a big group, individual investors. So they're the three groups that the text talks about that you have to make sure that you know. Just understand that when it comes to sentiment, we're dealing with index funds. They have no opinion, don't care what's going on. We have institutional managers, they do have an opinion, and they do care, and they do talk about their opinion out in publications. And then the individual investors as well, who are obviously care the most out of everybody. So when it comes to crowds, the issues, it's been written about since the 1800s. Charles Mackay wrote this book here, Extraordinary Popular Delusions and the Madness of Crowds. Really positive title there. Basically, he was talking about bubbles in his text. He talked about bubbles as being a great example of the madness of crowds. Michael Gladwell has written books and papers on this, in as much as a slow burning riots that go on as well, where, you know, people just see things happening and they just get captured by that. You know, they're a good and decent person and they would never fall. You know, they're smart. They wouldn't fall for something like that. But when the whole crowd does it, it's just this crowd psychology that takes over. So some interesting work. If you're interested in the psychology of it, Malcolm Gladwell, he wrote Tipping Point, and some of his more recent work has been on other forms of crowd psychology. We need to understand how crowds think and act, and that's the hardest thing when everybody is talking about all the money they made in a certain asset class, and you're sitting on the sidelines thinking, I should have got in, I should have got in, maybe this thing's going to keep going, maybe I should go and get in. You know, the fact is that once everybody starts talking about something, that's it, too late. You know, don't fall for jumping in on the crowd at that point. There will always be another opportunity, always. It's, no matter what, and it feels to me, doing this now for nearly 23, 24 years, that the opportunities are coming closer and closer together. So again, just be careful if you're investing in something like that. Although the crowd is bullish, there comes a point where all funds are committed. So if everybody in the world was bullish on Tesla and everybody was putting all their savings into it, at some point, everybody's put all their money in. And so there's no more buyers there to create a demand and increase, to keep the price going up. And so eventually what starts to happen is that we run out of buyers, the only people who are left are sellers, and the price starts falling based on that. So it's not that when we get to the end of a market that everybody suddenly changed their opinion, it's just that we've run out of buyers. And so there's no more fuel for the fire to keep that thing going up. And so then we get sellers and it keeps going down until we run out of sellers. And everybody becomes a buyer again because it represents such great value at these new prices. And that's then when we get the bottoms coming in. So extremes in sentiment mark the end of the trend. And so when we got everybody agreeing this is a great buy, that usually marks the end of the trend. And we talk about it before, we've talked about it in Dow theory. Typically it's the smart money, it is the big end of town that's been through so many cycles, they know what's going on. And unfortunately it's the uninformed public which just keep pouring funds into this cycle and they keep losing. All right, calculating sentiment. The logic of the crowd sentiment is obvious. You know, we understand why people are getting wrapped up in these sorts of things, but the value of sentiment is very difficult to calculate. We can't work that out. But we can use both market data and external survey data to help gauge sentiment. Now, this is where it's a little bit interesting because this chapter had a learning objective of, let's jump there, describe the challenges of using sentiment indicators. But this chapter didn't really talk much about indicators, unless it's to this point. You know, I really couldn't quite make a definite judgment on reading the text on whether it was about the price, the precise value of sentiment could never be known. Or it's to do with the specific examples later. You know, we're going to talk in the next two chapters about sentiment indicators based on the actual data sets that we can get hold of and we can calculate using mathematical models, and then also sentiment based on surveys and opinions and things like that. Even when I looked at those two chapters, I really found it a little bit difficult to say, well, what are the challenges of using sentiment indicators? The only thing that I can really point to is that typically sentiment indicators are late. You know, everybody's in bullish as we come up to the top, but then it's not until the market rolls over that suddenly they're bearish. It's really the only thing I could point you to as far as the text goes with that. So that's the first part of this. And now we'll jump in and we'll have a look at the actual indicators that we can build. So these are a number of standard indicators. You know, we cover them here in CMT1. We pretty much cover this again in CMT2, a little bit differently. But when you get there, we're going to reinforce all of this again. So we're going to talk about the VIX, we're going to talk about options volume and open interest, futures open interest as well, looking at the three groups of the commitment of traders report on futures and the open interest on futures, defining short interest and explain insider activity. So those key employees, directors, and tracking their trading behavior in their own companies. So jumping in again, I'm changing the order from the learning objectives only because I think this builds a lot better and flows a lot better. So futures open interest is the first one. So as we have shares outstanding, you know, so at any point in time, there is a float of shares which are available in the exchange for people to buy and sell. So that's the shares outstanding. Now that number doesn't go up and down very much unless, of course, options are getting exercised and the company's creating new shares, things like that. But unlike that, when it comes to futures contracts, so when we have a contract between a buyer and a seller, and we talked about that in the futures module, the futures chapter there, we have this situation where we have an open interest. These are contracts that are open, waiting to be fulfilled. And so we can look at that as a sentiment indicator. So the more, especially when you break it up between long open interest and short open interest, you know, if long open interest is climbing and growing, then we know that, okay, there is a belief this market is going up. If short open interest kept climbing, it would be indicating that the market was going down. Whenever we get an increase in open interest, it's telling us that new money is coming into that market. And so, you know, there's a lot of information that we can gain out of that. It supports the trend, whatever current trend's going along. If open interest is rising, well, that trend is being supported and we can expect that to continue. And so obviously this table, really this is just saying rising open interest supports whatever trend is predominant at that time, whereas falling is giving us an inclination that we may be nearing the end of that trend. All right, so put call ratio. Now if we go to options, which we also talked about, when we look at the open interest of put options versus call options, we can use that as a sentiment indicator as well. Now this is in particular because when you've got a large equity portfolio, one of the best things to do when you're concerned about a decline in the market is not necessarily to exit the position and sell, but rather to hedge with a put option. And so when we see the number of put options rising compared to the number of call options, then we know that there is a negative sentiment in the market and we expect the, you know, there's a distinct possibility that this market's going to roll over and start going down. So we can start to look at that. That's a very common one done on a per security basis. So as long as there's options available, you know, we can measure that on each security there. So the ratio is high when the volume of puts increases. A high ratio means that it's time to sell. Lower ratio that it's time to buy. It's because options are used as insurance, so an increase in puts versus calls tells us that traders are taking out insurance on their portfolios. All right, so that's that, and that actually plays into the VIX, which we'll talk about again in a moment. But another futures related sentiment indicator we can use is the COT data. Now, the Commitment of Traders is what COT stands for. It's a report put out by the Commodity Futures Trading Commission, unless of course there's a government shutdown, and then it stops, which we found out at the beginning of 2019. So it's looking at 3 different groups. So every week, all the exchanges and the brokerage houses, etc., they report to the CFTC how many outstanding contracts are still in the market for each commodity. And so they look at that and they break that up into commercials, large speculators and small speculators. There was a 4th category earlier on as well, money managers as well, but that's all been sort of put together into large speculators. As we talked about in futures, you know, with when you've got futures, you've got your commercials, which are typically the producers and then the consumers of the actual materials or the commodities. But then you also have the speculators in the middle, basically buying and selling purely for profit. And so, you know, we have those there. So looking at that, commercials, hedges, they're the firms that deal in the physical, you know, for example, farmers, oil producers, etc. They're also using futures to trade against business risk. So sometimes airlines will, even though they don't process crude oil themselves, they will buy futures in crude oil to hedge against the risk of oil rising and then their avgas or aviation gas becoming a lot more expensive. So, you know, they'll use futures in that way as well. Commercials are typically well capitalized also. Speculators, large and small, they have no intention of ever receiving the physical commodities. They're only in this to buy the contract and then on-sell the contract for profit. Distinction between large and small is based on trade size. A speculator that is long or short, more than 250 contracts, is classed as a large speculator. Most large specs are funds, money managers, or CTA, commodity trading advisors. And typically these groups are trend followers. They're just looking to get in on the trend and take advantage of some short-term gains. So the report looks like this, where we have this broken up. Now this is the disaggregated because we have swap dealers, money managers, and others, which is small, small speculators. These two are combined in the consolidated report into large speculators. But you see the producers there, we've got long and short, and then each of these groups, long and short, and we can see the open interest there, and we have the total open interest as well. So for each of these groups, we subtract the shorts from the longs over time, and we get this line here. So we can see our commercials, our large speculators, and our small speculators here. There's a lot of things we can do. As we said before in CMT3, when we get there, we talk a lot about indicators based on the COT data as well. All right, let me just make sure I got my notes here. Commercials create the supply and demand, and they're the ones who mainly drive the prices. That's why commercials are usually right. Because if the commercials are getting rid of their short positions and they're starting to buy, well, then that's going to create a lift. They're the big movers of price in here, much like a fund manager or a huge ETF is in the equity market. All right, insider activity. So insiders are one of the most important groups to watch. They're the key employees, they're the directors, the owner, the original founders of a company. Typically, the demarcation is anyone who owns 10% or more of a company's stock must report to the SEC whatever their buying and selling actions are. So when you first become a holder of more than 10%, you've got about 10 days to report to the SEC. But after that, once you're on the books as being an insider, then you have to report all transactions within 2 days of making those transactions. So that really defines what an insider is. Their buying and selling provides us interesting insights into their sentiment. And insiders are often buying at short-term bottoms. It's very interesting actually when you look at charts and you see where there's been a tick up in insider volume and things like that. Anyone with more than 10% must report to the SEC. So when we look at insiders and we think about the two things they could be doing, they can be selling, they can be buying. The fact is that when they're selling, they can be selling for a variety of reasons. Obviously, one is they think the company's in trouble, but it can also be that their kids are going off to college. So, you know, if you see selling behavior happening around the start of a school year, well, you know, think about college, because there could be people pulling money out for that. Maybe they're doing a renovation, you know, maybe they want to go on a vacation, whatever. There's a number of reasons why an insider may sell their stock. But when it comes to buying, there really is only pretty much one reason, and that is because they believe that the stock is going to go up. Now, mostly they believe it in the short term. Sometimes you can have the original founders of a company who will just be buying up stock. They want to shore up the price. They want to hold it because they know what's coming in 3 years' time and they believe that it's going to go up. But typically when you see insider activity, and when the founder's not so prevalent, I think that's the other part to this. Then that definitely is something where, you know, you look at that buying and you say, hang on, they know something, they know what's coming, we better jump in on this as well. All right, let me have a look, make sure I've got all these points covered. Insider sales can be indicative of a bearish sentiment, but it's really the volume. If you saw a lot of selling volume, well, then I would be thinking, hang on, there's something going on that they know about. If it was just a little bit here and there from different insiders, you know, that could be for any reason. So again, size of the position is important. Again, buying, the size is important, as in with selling. You know, if there's a lot of buying going on by insiders, they all definitely know something's going on, and they're buying up the stock. Obviously, this gets really close to insider trading, and this is why all these forms have to be submitted to the SEC. Fact is, it's hard not to act on information like that. Definitely not something that I think the SEC or anyone would condone. But nevertheless, we've got to keep an eye on it because it's an indicator that we can use. Short interest. So when we have shares and you may have a feeling that this share is going to go down, what you can do is sell shares that you don't have. Essentially, you borrow them from one person, let's say Peter, and you sell them to Paul. And so when the price goes down, you buy back shares to pay off Peter again. And that's the way the short interest. But again, the number of shares that have been sold short is listed. So like we have open interest in the futures market and the options market, we have short interest, which is the number of shares outstanding, number of short sales that are outstanding waiting to be fulfilled or closed out. It's settled with shares lent to the short seller by a third party, e.g. Peter, and they went and on-sold what they borrowed. The seller makes the sale on the assumption that the price will go down. The seller purchases shares to cover the shares previously borrowed. Pretty much what I just said. In the stock market, there's a huge disparity between longs and shorts. 99.9% of all equity trades are long, and very stable, etc. It's a very small percentage that are short. Nevertheless, we can look at that. We can look at that as a sentiment indicator as well. Exchanges report the number of shares being held short, too many shorts, and there is a risk of a strong covering rally. So one of the things we have, when you've got a short trade, see, if I bought this equity, and look, it's at $100, whatever, $110 at that point. If I bought that, I know my maximum loss is $110. That's it. There is a floor where my loss is capped. When I'm short selling, if the price just escapes and just keeps going up through this massive bubble, there is no limit. Obviously there comes a point where the buyers run out and sentiment turns, but nevertheless, theoretically, it could just keep going up. And so that's why when we start to see a rally forming, there are a lot of people with shorts that will get out at whatever price as quickly as they can, which then obviously, because they're buying, feeds that rally even more. And that's why out of a lot of these lows, we see sharp runs up out of bottoms in the market as well. And that's because of the short interest. So you can see here on Apple, we've got short interest when it peaks out, and then obviously getting smaller and smaller at different times as well. So yeah, very interesting there. They'll buy to cover no matter what, as I said. So another metric which is very important is days to cover, and that's another one that we watch. So essentially what we look at and say is, let's take the average volume that's traded for Tesla, and then let's look at the value, the number of shares which are outstanding on a short interest basis, and then divide the number of short interest shares by the typical volume. And that gives us days to cover. So you can see here when I did this in January 2019, we're sitting at 3.1 days to cover. So if all the shorts ran for the exits, it would take 3.1 days for them to sell or to buy back, I should say, all of the shares needed to settle their accounts. So that's what, again, is what creates these things. So when we see short interest, days to cover getting higher and higher, it actually becomes a bullish sentiment. Even though what led to them selling the stock short was a bearish sentiment, it actually turns into being a very bullish signal because of that rally. As soon as that rally starts, bang, they have got to get out of the market and get out quick, which again makes a great opportunity. So it's an important number that we keep an eye on. If these numbers are high, the bearish trade is overcrowded. Options can be used to hedge risk. So sometimes with short interest, if the exit is just way too crowded, better to take call options to hedge out the risk of the rally there. All right, volatility. Now, before we talked about put and call and the open interest of those, looking at that as a ratio of put options to call options, well, they also feed in to the volatility calculations. So for volatility, now we've got historical volatility measures. We have purely standard deviation drives the historical volatility tool, looking at the average price and the variation of closes around that. just standard variance type calculations from statistics. We also use ATR as a measure of volatility. It's one of the more popular ones, but that's all measuring backwards in time. But if we want to know what do we expect the volatility to be over the next 30 days, well, then what we do is we take the options, the put options, the call options. We look at the average price of the 30-day, the next month 30-day options, and we look at the disparity between them. And then the calculation comes back to say, okay, well, this is what the implied volatility is. It's implied by the sale of options and the volume of options that are outstanding there. It hasn't happened. We don't know if it's going to be that volatile, but it's what we're implying is going to happen. And you can see here, we've got the S&P 500 through 2018, and we have the VIX. So in January, February, a large spike where we had a lot of, obviously a market correction going on, a lot of fear going on in the VIX, and we get a spike there. Coming in again through late 2018. Again, it's a very interesting one to me, how this one sharp drop obviously took a lot of people by surprise. So there must have been a lot of option buying going on. But then when we come to this one, which is almost as far down, but maybe not quite as vicious as the first one, we still don't see such a big spike in fear until we get this last drop at the beginning of January, end of December. So VIX is also known as a fear index, represents a 30-day expected volatility. So by having a value here at 30, that's saying we expect over the next 30 days, the S&P 500 will have a volatility of about 30 points. And so, we look out for that. Derived from the real-time mid-quote prices of S&P 500 options. All right, so that is sentiments from market data. These are things that we can measure and calculate and use as part of our process to identify whether we feel like the market's going up, going down. What's the sentiment? It's not necessarily that we always follow and trade with sentiment. We talk more about that in the next chapter, but we need to know what the sentiment is and then do analysis, do quantitative testing. Is it better to trade with sentiment or against sentiment? That's where more research, I think, needs to be done as well. So describing VIX as a sentiment measure, it's the fear index. It is a lagging index. That's one thing that I'll sort of point out. It's reactive to price in the S&P 500. Really, I don't ever see it leading a drop in the market. That's where I think it has some limited use in that regard. There are some other ways that we can use it, and particularly when we look at VIX futures in CMT3, that can help as well. Explaining the use of options volume, so the put-call ratio, but also as a driver into VIX there. Describe the use of futures open interest. So looking at when open interest is rising, more people are getting in and supporting that trend there. Identify the three primary groups in the commitment of traders. It's the commercials or hedgers. That term's interchangeable there for that group. The large speculators and then the small speculators are the three groups there. Defining short interest, selling shares that we have borrowed and hoping that the market will go down. I think it's really important that you remember about the covering rally that can go on as well there. And then explaining insider activity, what insiders are doing, the difference between buying and selling is important to remember as well. All right, so now the last chapter we've got here in sentiment is all about external forms of sentiment and where we can go and get a gauge of what the market is feeling. So we want to describe the use of news and advisories as sentiment indicators, explain the concept of a contrarian opinion, and also indicate how mutual fund cash and other fund measures are used to gauge sentiment as well. So jumping in, obviously survey data is a great way of gauging sentiment. There's two main ones. that are out there. There's the American Association of Individual Investors, where individual investors basically just fill out a quick little survey. What do you think of the market? Are you bullish, bearish, or neutral? And they fill that out, etc. And then there's the Advisor Sentiment Report. That's more of a professional one where fund managers and financial advisors are asked to fill out what is their sentiment about the market. And where do they feel like the market's going. That can also fall into the category of newsletter writers, the people who put out research publicly for other people to consume, etc. They all fall under that Advisor Sentiment Report there. When it comes to the individual investors, the research goes on to say that the best signals, the best long-term signal, if you like, actually comes from when the investors are neutral, when the average group is neutral. So when they're all really bullish, that's no good. It's usually too late by that stage. When they're all bearish, well, there's still some downward movement in the market to go. But when they're neutral, what the research found was that 6 months after a neutral reading, a neutral result was gathered by the survey. 6 months later, there was a rise of 8.6% in the S&P. 1 year later, it was a rise of 17.7%. And that's the average, so the median. That's the median rise after that event happening. So that's definitely something to watch out for. Contrarian opinions. So when it comes to these letter writers and research advisors, etc., they don't want to be wrong. They don't want to be the first one to put the hand up and say, there's a bear market coming. And so everybody sort of toes the party line, if you like. They're basically saying, market's up, it's going to continue going up. These are the ones we think are strong buys. Got a little bit of concern, but typically their opinion is bullish. And it's very hard when you're running a business and you are relying on people to agree with your opinion. Because if people don't agree with you, if your subscribers don't agree that you are telling them what they want to hear, they'll go elsewhere where they find it. I think I've said this before, but it's one of the crimes with the selective news society that we live in now, where I can choose to listen to the exact news which confirms all my beliefs and opinions. I never hear a contrary opinion when it comes to news. Between social media and viewing content online, I'm curating everything that I hear. Same thing happens here with the markets. People have an opinion about the market and they're curating the people that they listen to, the people they'll follow on Twitter. So if someone comes along and has a completely opposite opinion to them, well, they're like, that person's an idiot. I don't want to follow them. And unfortunately what they're doing is they're blocking out a possible contrary opinion, which could actually add a lot of value. It's not necessarily that person's right or wrong. All I would implore you to do is to make sure that you keep an open mind and listen to other voices out there. Don't just listen to voices that say the same thing. Find out why they're saying what they do. You don't have to agree with them, but do understand where they're coming from and why, what analysis they're doing to come to that opinion. Anyway, I'm digressing. Most subscribers want their opinion to be confirmed. They don't want it to be challenged. So newsletter writers have this issue that they really have to follow the trend and follow the crowd. Otherwise, they risk losing substantial income to their business. There are often many writers who are most bullish at the top and bearish at the bottom. We need to look for trades in the opposite direction when the voices are all saying the same thing. News stories. Now this picture here, this is from the Fidelity chart room in Boston. It was a huge room. I think it's a bit smaller now, but when I first saw it back in 2010 or something like that, it was probably around about 50 to 60 yards long, about 10 yards wide, and just full of charts. But this was one that really captured my interest. And that was where what they'd done is got post-stamp sized magazine covers and put them on the history of the S&P 500. And basically the premise was magazines are wrong. There's lots of Economist magazines, Time magazines, Business Review weekly magazines, all these magazines there. And when you get around these major lows in the market, all the magazines are saying, that's it, it's going to go down another 1,000 points. It's terrible. But then when we get to the top, they're all saying how great it is, and this is the new day. Everything's changed. We can't have a correction like we had before because of all these wonderful changes that are there. And yet it happens again and again, over and over. There's a classic one, which I think it might have been that one, where it was talking a lot about real estate and how real estate had completely changed, the fundamentals had changed, and we would never have a crash in real estate prices again. And lo and behold, in 2007, of course, we did, 2008. Journalists and editors, again, so news stories, they're a big sentiment indicator, but definitely a contrarian one. When you write, so when it comes to editors, etc., when we have a pretty standard market condition, they're going to try and have opposing views in their papers or in their articles and their magazines. And so they're pretty balanced with that. But when we get to a point where there is a real strong opinion and everybody's bullish and everyone's talking about how great this market is, that's then when you'll see them sway over to confirming what the crowd believes. And so they're pulled out over to that end. And so when you see that happen, it really is a sign that, hang on, this move's over. It's time to really protect any investments or to jump out of there. Mutual fund cash asset ratio. Now this is interesting because there's a chapter on this, or a section on this in the chapter, basically explaining what it is, that it's mutual funds, they're the biggest buyer of equities, and then the indicator basically tracks the amount of cash that these funds have. Because the premise is, if these funds are holding cash, it's because they're expecting to buy and expecting to buy soon into the market. But at the end of the section, it actually says, well, this isn't working anymore, and then it doesn't go on to say anything else. I'm not sure if you're going to get asked a question. I think you really should know that the mutual fund cash asset ratio is that mutual funds have a holding in cash, and typically that's used to buy equities. And so that's why it's seen as increased cash. If that cash is getting higher and higher and higher, then it's seen as a bullish signal because, well, that cash has got to go somewhere. They can't just leave it in cash and just get risk-free interest rates. Their investors won't be happy with that. So they've got to commit at some point. So that's why it's deemed as a bullish one. As long as you know that, that'll be fine for the exam. The money market fund assets. Now this one we got a little more data for. So again, there are times where, because we obviously include the workbooks for Optima. In this case, I haven't, because this one is coming directly from Bloomberg. You'd have to have Bloomberg to link Optima up to Bloomberg and be able to pull this data out. So it didn't make sense to include that. If you are using the Optima software as part of the free Optima software that we give to CMT candidates, and you want to link it to Bloomberg, just let our support department know, and they'll add that for you. So money market funds are accounts which invest in cash for short terms. Now, typically when somebody has a brokerage account and they're sold out of a large equity position or something like that, they don't necessarily take that money out and put it in their personal bank account. The money stays in the brokerage account. And typically that's invested at short terms for 30 days less, not really much longer, in the money market. So when we see the money market funds keep growing, those assets growing bigger and bigger and bigger, well, again, just like before, the assumption is that's a lot of money sitting on the sideline waiting to be invested somewhere. So it becomes a bullish signal. Now, here you can see that here. So what we've got is the market capitalization of the US exchanges, so all the stocks, etc. And then we have the mutual fund cash here. And you can see that as 2008, 2009 happened, this value got higher, much, much higher. And so when we look at the mutual fund cash to the assets ratio, this is what we get here. And so we see this peaking out and then starting to drop away as 2009 happens and more funds are getting committed. So as we see this going down lower and lower and lower, the expectation is the equity market is going to be growing because more and more funds are getting put back into the market, creating the buying pressure, which is going to lift the prices of the equities. So it's seen as a bullish sign. All right, so that's sentiment indicators from external data. So describing the news, the use of news and advisory services. Make sure you're aware of those two surveys from the private investors, the individual investors, and the advisor sentiment report. Explaining the concept of contrary opinion. So essentially, whatever these guys are doing, we want to be looking at doing the opposite there. And then indicate how mutual fund cash and other funds are used to gauge sentiment. All of those are based on this premise that if there is a large holding of cash, that cash has to be invested at some point. And so as the market starts to rise, that cash is going to be pouring in into those markets. All right, thank you very much. We'll continue on with the next lesson.